This chart shows a common, painful scenario. You spot a classic pattern, confidently enter a position, and immediately watch the market plunge into a sudden, aggressive loss. For intermediate traders, the head and shoulders pattern is a staple signal for identifying when an established trend is about to reverse. But executing trades based solely on the visual outline of a shape is a massive vulnerability. It creates a blind spot that frequently traps your capital. Building a sustainable edge requires looking under the hood. You have to confirm the market psychology, volume, and momentum before the trade is valid. When you ignore these hidden data layers, you transform a logical strategy into a reckless gamble. This chart illustrates the required context. The pattern must appear at the exhaustion point of a strong uptrend, a period where prices have been consistently rising. The first peak, or the left shoulder, and the even higher central peak, known as the head, represent the final pushes of market optimism. This is the point where buyers begin losing their grip on the trend. The third peak, the right shoulder, is your primary warning. Because it forms a lower high, it visualizes creeping doubt and failing momentum among the buyers. To prove this shape has actual weight behind it, we look at volume, the total amount of an asset being traded over a specific time. You want to see high volume on the first peak, a slight fade at the head, and critically low participation as that final lower peak forms. If a chart forms these peaks without a corresponding decay in volume, it is a trap. It indicates that the true selling pressure necessary for a reversal hasn't arrived yet. Advanced confirmation comes from bearish divergence. This uses an oscillator, a technical indicator that fluctuates between levels to measure the speed of price changes. Even when the price makes a higher high, the oscillator makes a lower high. This reveals the underlying engine of the market is stalling out. Connecting the lows between the shoulders gives us the neckline. This is the absolute line in the sand for the current trend. Pay attention to the slope. While a horizontal line is standard, a downward sloping neckline indicates sellers are becoming aggressive even before the pattern is finished. The trigger occurs here. The price decisively crosses the neckline, synchronized with a massive spike in volume that confirms sellers have taken control. This precise convergence of shape, divergence, and volume at the neckline transforms a visual theory into a high-probability trade. You have two ways to enter a short trade, which is a position that profits if the price falls. You can enter aggressively on the break, or wait for the price to retest the neckline and reject it from below. Regardless of the entry, you must use a hard stop-loss. This is an automatic order that closes your trade at a specific price to prevent further losses if the market moves against you. The most logical placement for this stop-loss is just above the high of the right shoulder. If the price reaches that level, the bearish thesis is no longer valid. To find your profit target, we use the pattern's geometry. Measure the vertical distance from the very top of the head down to the neckline. Take that measurement and project it downward. This distance, measured from the breakout point, identifies your primary exit target. By defining these mathematical exit points before you enter, you remove emotion from the execution of the trade. Because even perfect patterns can fail, you need a defense. This formula determines your position size based on your account balance, risk percentage, and the distance to your stop loss in pips, a pip being the smallest unit of price movement in a currency pair. Using this calculation ensures your dollar loss is strictly controlled and predetermined, no matter how much space you give the trade to breathe. This same logic works in reverse for market bottoms. The inverse head and shoulders uses the same volume and neckline principles to identify bullish reversals. Consistency in this market requires looking past the geometric lines on the screen to analyze the underlying psychological shifts backed by hard data. Practice layering these specific volume and momentum confirmations on a demo account. It allows you to refine your eye for high probability setups without risking your capital. Mastering these hidden data layers is the definitive step in moving from speculative guesswork to a systematic, professional trading process.